You've also said that labor costs, that falling wage costs should help to boost stocks. That's what I was looking at in your most recent research and thinking about. Mickey Bowman has been talking about the effect of immigration on the labor market and costs there. And I was just thinking, if the Biden administration has finally stopped, the flood of immigrants over the border, and if maybe the next administration continues to hold that tight and even, send some workers home to their original countries, don't we see upward pressure on wages coming to us?
Well, I think you want to think about it as a portfolio manager. And the question there is to focus on the distribution of labor costs, the cost sensitivity of a company to its input of labor and workers. And so if you look at this, Matt, as a overall market, something like 12% of the sales of a typical company are consumed by the labor budget. Use that term, labor budget. That's your wages, your salaries, your bonuses, your healthcare costs. All that is going to consume around 12% for the overall market, maybe 14% for the typical stock. And you want to look at it, and the way we think about it is the distribution. There are some companies where that ratio is at the low end, maybe 5%, 6%. And there are other industries, other companies where it's closer to 30%. So now you can start to identify as an investor which companies have more leverage, which have more torque to the idea of a slowing wage inflation environment. And those are companies where the labor cost ratio can be high, where the potential benefits from slower growth in wages could be a benefit to the share prices. And in fact, in the last couple of weeks, we've seen around 9 percentage points excess return for high labor cost companies relative to lower labor cost companies. You think of that long short from a hedge fund perspective. That's how we think about it as an investor.
So you're using it in active management, because if I just look at the market as a whole, I can understand how lower labor costs would benefit the bottom line of these companies when they come out for earnings. On the other hand, it really hurts consumer confidence, or it looks like maybe it has an effect on consumer confidence. We get a big miss on that today. And then, in turn, consumer spending.
So, yes, the consumer area is an interesting one. If you look at consumer staples, for example, a typical company is about 9% of its cost structure is consumed by labor. So, first of all, we want to think of that. The rest of the cost structure of a company is its materials or it's the actual foodstuffs, what have you, depending on the company, consumer products or the food company, for example. So labor, you got to put that in context. But to the extent that their margins as a general industry are pretty low, that makes a big difference. On the other hand, look at technology, the other end of the distribution. You got, generally speaking, higher compensated employees, and their ratio of the labor budget to the revenues is much higher. On the other hand, their margins are also higher. And so there's different ways of thinking about companies. There's companies in each industry where there are higher or lower cost structures and labor. And so we want to keep that labor cost in context as a way of identifying individual companies. I think the way we focus most attention right now is on mid-cap stocks, because mid-cap stocks is the area of the market that's gets the least attention by the part of many portfolio managers. I just spent a couple of days visiting with almost 45 portfolio managers, and lots of discussions on large cap and small cap, but what is not generally on their radar screen is mid-caps. Mid-cap stocks have a long track record of better performance than large cap and small caps. Number one, they trade at much lower multiples, 15 times. The overall market's closer to 21, almost 22 times in some cases. So you got better value. They are the best performance after a Fed cut. The Fed obviously cut last week, so over the 3-month, over a 12-month period of time, mid-cap stocks tend to do better. And so that's the area of focus for most, that's what we're certainly talking about with fund managers, an area that's not overlooked, if you will, but really is likely to outperform in the coming year. Looking at something like 13% upside over the next 12 months, broadly speaking, the market maybe is closer to mid-single digits.